What if the global financial system you've trusted for years is on the brink of collapse? The US dollar, once the cornerstone of international trade, is now facing a massive challenge, one driven by geopolitical tensions from the world's most powerful nations, China, Japan, and Russia. As these countries work to bypass the dollar in favor of their own currencies, the very structure of global finance is starting to shift. But what does this mean for you? Higher inflation, rising costs, and potential economic instability are just the beginning. This challenge isn't just a theory, it's already happening. China's economy is now the second largest in the world, and it has been strategically stockpiling gold, with over 100 tons added in 2023 alone. Similarly, Russia has been diversifying its reserves, selling oil to countries like China and India in currencies other than the dollar. Moreover, Japan, largest buyer of U.S. Treasuries, has started to sell off U.S. bonds as an action to lower interest rates in the country. If this trend continues, we could see the dollar lose its status as the global reserve currency, leading to higher interest rates and volatile oil prices. The ripple effects would be felt globally, impacting everything from fuel costs to international trade. The tension between these two nations could be the beginning of a new financial era where the dominance of the US dollar is no longer guaranteed. What does this mean for you? Higher costs, greater instability, and a financial system that is far more unpredictable than ever before. Stay tuned as we break down the forces at play and how this shift might impact your daily life. For decades, Japan has been one of the largest buyers of U.S. Treasuries, supporting America's financial stability. However, this trend is now reversing. Japan's government has recently embarked on an unprecedented sell-off of U.S. bonds. This shift is primarily driven by higher interest rates at home. In March 2024, Japan's Bank of Japan (BOJ) raised interest rates for the first time in 17 years, signaling a significant change in its monetary policy. The BOJ's decision to end its negative interest rate policy is a reflection of Japan's desire to strengthen its economy and regain control over its financial situation. Japan's growing defense, spending, and economic revitalization plans under Prime Minister Shigeru Ishiba require more liquidity at home. Moreover, Japan is increasingly uncomfortable with the U.S. foreign policy. Especially in the Asia-Pacific region, Japan's strained diplomatic ties with the U.S. over its aggressive stance toward China have added another layer of complexity to this shift. Selling off U.S. bonds isn't just an economic decision, it's a strategic hedge against rising regional tensions. As a result of Japan's sell-off, the global bond market is being shaken. This could lead to increased borrowing costs for countries and businesses that rely on U.S. debt, affecting everything from home loans to auto loans. In particular, interest rates on loans and mortgages may rise, making it more expensive for individuals to finance major purchases. Now, let's look at Saudi Arabia, a key player in the global oil market. For decades, Saudi Arabia has maintained its oil trade exclusively in U.S. dollars, reinforcing the so-called petrodollar system. However, recent developments indicate that this partnership may be weakening. In 2023, Saudi Arabia signed a series of major trade and energy deals with China, including discussions on accepting the yuan for oil transactions. If Riyadh decides to price oil in yuan, this would directly challenge the petrodollar system and could have profound implications for the U.S. dollar. The political tension between the U.S. and Saudi Arabia, especially over issues like human rights concerns and disputes regarding OPEC production cuts, has strained their alliance. On the other hand, China offers a more stable trade partnership with fewer political strings attached. If Saudi Arabia moves forward with yuan-based oil pricing, it would send a clear signal to other oil-producing nations to diversify their reserve currencies, further challenging the dollar's dominance in global trade. The implications of Saudi Arabia's decision could be far-reaching. If the petrodollar system collapses, the price of oil and energy could become more volatile, potentially leading to fluctuating gas prices. People around the world could feel the impact through higher transportation costs, inflation, and economic instability, especially in countries dependent on oil imports. Another factor eroding the U.S. dollar's dominance is the rise of alternative reserves. For years, the dollar was seen as the global reserve currency, but this is no longer the case. Central banks around the world have been stockpiling gold at record levels. According to the IMF data, global gold reserves reached an all-time high in 2023. For example, China added over 225 tons of gold to its reserves as part of its strategy to reduce its reliance on the US dollar. Similarly, Russia and India have also been boosting their gold reserves. In addition to gold, countries are increasingly exploring the potential of cryptocurrencies and digital currencies. Countries like El Salvador have adopted Bitcoin as legal tender, while others are experimenting with central bank digital currencies, CBDCs. This trend signifies a shift away from traditional fiat currencies, as nations look for ways to protect themselves from the financial risks associated with the US dollar. The rise of alternative reserves means that inflationary risks associated with the US dollar could become more pronounced. If more countries switch to using gold or cryptocurrency, the global financial system could become more fragmented, potentially leading to currency volatility. This could directly affect individual savings, investment strategies, and financial security. For everyday consumers, this could lead to increased costs for goods and services as the value of the dollar fluctuates. The Federal Reserve has been playing a crucial role in the dollar's current predicament. Its decision to raise interest rates aggressively in an effort to curb inflation has had unintended consequences. On the one hand, these higher rates have attracted foreign capital into U.S. bonds, offering better returns. On the other hand, rising interest rates have triggered a massive sell-off of existing bonds, creating a paradox. As interest rates rise, bond prices fall, which is a basic market mechanism. Another problem is the rising cost of servicing the U.S.'s $36.56 trillion national debt. As interest rates increase, so do the payments on this debt, which creates fiscal pressure on the U.S. budget. If foreign bondholders continue to sell U.S. bonds, the U.S. could face a fiscal crisis, where rising debt payments crowd out other government spending, potentially leading to political and economic instability. The Fed's interest rate hikes and the potential fiscal crisis in the U.S. could lead to higher borrowing costs for individuals. Mortgages, student loans, and credit card interest rates could rise, impacting household budgets. Moreover, the government's fiscal challenges could result in cuts to public services, affecting healthcare, education, and social security programs, which many individuals rely on. Following Brexit, the United Kingdom has been reassessing its economic and financial strategy. Historically, the UK was one of the closest allies of the US, but the political and economic shifts brought on by Brexit have forced the UK to seek financial independence. A key part of this strategy is reducing reliance on US bonds. The UK has been focusing on strengthening trade relations with the European Union and Asia, especially with China. By diversifying reserves and reducing exposure to US bonds, the UK aims to reduce the risks associated with its reliance on the US dollar. For the average consumer, this shift could lead to a reduction in the strength of the pound against other currencies, which could impact import prices and inflation in the UK. Additionally, job markets and trade could experience volatility as the UK seeks to establish new financial relationships outside of its long-standing reliance on the US. The US is facing significant political instability, which is now becoming a global concern. From debt ceiling battles to government shutdowns, the dysfunction in Washington has started to affect international confidence in US leadership. The Fitch downgrade of the US credit rating in 2023 is a stark reminder of the financial risks posed by the country's internal dysfunction. The political gridlock in Washington can lead to uncertainty in the markets, increasing the likelihood of economic downturns and financial instability. For everyday citizens, this could result in job insecurity, economic slowdowns, and uncertainty about future government policies. Lastly, let's focus on the two biggest geopolitical challengers to US dollar dominance. China and Russia. Both countries have been working to undermine the US dollar's global influence by expanding trade agreements that bypass the dollar. The Belt and Road Initiative by China and Russia's move to sell oil in non-dollar currencies have furthered this agenda. If China and Russia succeed in reducing the global reliance on the US dollar, we could see a shift in global trade patterns, affecting everything from prices to economic relations between countries. Consumers may experience higher costs for imports, and the value of the dollar could fluctuate unpredictably, leading to a more unstable global economy. As we've explored, the US dollar's dominance is facing significant challenges from countries like Japan, Saudi Arabia, the UK, and even China and Russia. These geopolitical shifts are reshaping the global financial landscape, with massive sell-offs of US bonds, alternative reserves gaining traction, and political instability in Washington threatening US financial leadership. For everyday people, this means higher borrowing costs, inflation, and financial instability. The future of the dollar is uncertain, and we'll need to stay vigilant as these changes unfold. What do you think? Are we witnessing the end of dollar dominance, or can the US adapt and reclaim its financial leadership? Let us know in the comments below. Don't forget to hit that like button and subscribe for more updates on the shifting global financial landscape.
Costs and unpredictable policy shifts. Companies are forced to reconfigure their supply chains while consumers adjust their spending habits. Many businesses have begun looking for alternatives to mitigate tariff impacts. Some companies are shifting production from China to countries like Mexico, Vietnam, or even back to the United States. For instance, a machine tool manufacturer in Wisconsin recently moved part of its production to Mexico, but then had to reconsider when news broke that proposed tariffs on Mexican imports could negate the cost advantages. Similarly, small businesses with thinner margins are scrambling to renegotiate supplier contracts or diversify their product sources. Small businesses in particular are feeling the pressure. With less diversified supply chains, many are forced to either absorb increased costs or pass them along to consumers. In some cases, companies have even begun stockpiling inventory to hedge against anticipated price increases. But such measures can only go so far before they disrupt normal operations. On the consumer front, uncertainty often leads to behavioral changes. Recent surveys show that 1 in 5 Americans have started stockpiling non-perishable items like canned goods, toiletries, and cleaning supplies in anticipation of further price hikes. This behavior, reminiscent of early pandemic panic buying, not only strains local supply chains, but also results in temporary shortages on store shelves. Moreover, as consumers brace for higher costs, many are cutting back on discretionary spending, impacting everything from dining out to leisure activities. According to PYM&TS Intelligence, about 48.6% of consumers plan to save more money in response to economic uncertainty, a clear signal that many are bracing for higher costs ahead. Chapter 6. Looking ahead, future prospects. Many economists warn that if tariffs remain in place, businesses may delay or cancel investment projects, and consumer spending could decline further. This scenario could lead to a slowdown in GDP growth, reduced job creation, and an overall dampening of economic dynamism. At the same time, industries that adapt successfully may find new opportunities, but not without initial pain. Looking ahead, several factors will determine the eventual outcome. These include the duration of tariff policies, the extent of retaliatory measures by trading partners, and the adaptability of American businesses. For instance, if the U.S. government and its trading partners can reach mutually beneficial agreements, some of the adverse effects might be mitigated. However, if the policy uncertainty continues, both businesses and households will have to adapt to a world with higher prices and reduced disposable income. For the everyday consumer, this means planning for a future where everyday essentials might cost more. A recent study by the Budget Lab at Yale University estimated that if tariffs remain, American households could lose between $1,900 and $7,600 in disposable income over the next decade. That's money that could have gone toward healthcare, education, or even retirement savings. Families might have to revise their budgets, cut back on luxuries, and save more for emergencies. Trump's tariff policies have far-reaching consequences that extend well beyond the realms of international trade and economic statistics. While the administration's stated goal is to protect American jobs and reduce trade imbalances, the reality is that these tariffs function as hidden taxes raising prices on everything from automobiles to household appliances. This, in turn, squeezes family budgets and creates uncertainty across global supply chains. How would these changes affect your life? Let us know in the comment.